Hi, in this video I'm going to talk about the balance sheet and how you can analyze a balance sheet. So if you're interested, make sure to stick around as we're starting right now. In simple words, a balance sheet will tell what items a company has and whether the company owns it or others own it. The items a company has can be money, machinery, and factory, and it can be owned by either a bank or individual investors. The stuff the company has is called the assets of the company, and depending on who owns them, they are called liabilities or equities. Let me give you a very common example. Almost everybody dreams of being a homeowner one day. Suppose you found your dream home costing $300,000. You took a mortgage for $270,000 and made a down payment of $30,000. In this case, can you identify assets, liabilities, and equity? Think for a minute. Your house is your asset. Since you owe the bank $270,000, it is your liability. And because you made a down payment of $30,000, that $30,000 is your equity. That being said, assets should be always equal to liability plus equity. It is for this same reason it is called the balance sheet. A balance sheet reports a company's assets, liabilities, and shareholders' equity at a specific point in time. It tells you what you own or who owns your stuff at that time. Since it is just a snapshot in time, you need to compare it with another time frame in the past to get a fuller picture of a company's performance. Now, let's take a look at a sample balance sheet. All balance sheets follow a similar structure and will include assets, liabilities, and shareholders' equity. A balance sheet begins with assets. In any business, cash is the king, and depending on how long it takes to convert assets into cash, assets are classified into current and non-current assets. Current assets are those that can be converted to cash in a year or less. Non-current assets take more than a year to be converted to cash. Current assets begin with cash and cash equivalents. Obviously, this is hard cash or bonds which can be converted into cash right away. Next, we have short-term investments, which includes but not limited to treasury bills and certificate of deposit. If you don't know what a CD is, I've already done a video about it, so make sure to check it out. The next item is accounts receivable. Customers may consume services offered by the business without making ready payments. Some of them may not even pay. Accounts receivable refers to the money that customers owe the company. Companies should keep accounts receivable in manageable numbers, as a growing accounts receivable will slow down the business and can even lead to bankruptcy. Moving on, we have inventory. Unused inventory is frozen cash and it can lead to insolvency. Boeing is a good example for this situation. Following the 737 MAX crisis, Boeing is sitting on a huge inventory of 737s as evident from its balance sheet. Now let's head on to non-current assets. This will include land, machinery, and buildings. As discussed in my previous video about income statement, depreciation is a non-cash expense which will allow us to depreciate the value of some of our non-current assets. This is done to reduce the tax bill. Some companies, when they prepare the balance sheet, will show the value of the asset post-depreciation, while others will list depreciation as a separate item. In this example, I have listed the value of the company's buildings after depreciation. The next section of the balance sheet talks about liabilities and shareholders' equity. Liabilities are classified into current and non-current liabilities. Current liabilities are obligations that should be paid off within a year. This includes accounts payable, which is nothing but the money owed by the company, and short-term debt. Businesses may borrow or take loans with term length of 1 year or less to finance projects. These kinds of debts are referred to as short-term debts. Conversely, non-current liabilities include long-term debt which is due in more than 1 year. Next on the list is equity and is broken down to retained earnings and common shares. Retained earnings is the link between the income statement and the balance sheet and is simply the net income from the previous period. Then we have common shares issued to the shareholders. Now let's walk through an example and compare the balance sheet for 2018 and 2019. As I said earlier, assets should always be equal to liabilities plus equity. I've included two additional columns to understand the dollar change and the percentage change for each item. Cash balance increased by 125%, which is awesome. Accounts receivable is $15,000, which is not bad. Inventory grew by a small amount, which is not that great of a concern. For buildings, we accounted for $50,000 depreciation and the company purchased more land and machinery. So far, so good. Accounts payable grew by 150%. Company added $50,000 in short-term debt and $400,000 in long-term debt. Obviously, debt increased but not at a concerning level. Keep in mind that debt becomes a problem only if the company's earnings are not sufficient to pay off debt in a few years. Next, earnings declined and the company bought back some common shares. A decline in earnings is not what you want to see in a company that you are looking to invest in. This does not mean that the company is not good for investment. What it means is that you need to dig deeper to understand what caused the decline in earnings. Maybe the company paid a hefty dividend or the company made an acquisition. It is just a red flag indicating that the investors should use caution. Like any financial statement, balance sheet for a particular year alone will not make any sense. Things become clear only when you start comparing it with previous years, and investors should look for trends. That being said, I hope by now you have a fair idea on how you could use a balance sheet to understand the company's finances. In my next video, I will be going through the cash flow statement in detail. So stay tuned by subscribing to my channel, and until we see next time, thanks for watching. Bye.